Good afternoon. It's Friday the 20th of March 2020. Thought it was a good idea to update all of our clients again with another little short video about the market volatility that we're seeing this week. It's been absolutely crazy. Stock markets all over the world have continued to fall, even though again I think like last Friday afternoon when I did the last update, the markets are in a green or a net positive position today. We've seen world governments come together to offer all sorts of different stimulus packages. Interest rates in the UK are now down to 0.1%, and we're sort of hearing sort of negative stories about what might happen in this country and around Europe and America as to where this virus might go next. The purpose therefore of this video, again like we did last week, was to try and reassure as many people as possible. I know I've spoken with a few clients this week, and as I say, if people still want to ring and get in touch with you, please do that. Send emails. We've sent emails out to various clients this morning about certain funds in a particular portfolio that only affect, as I say, certain clients. We've emailed those about making changes, but overall our position and our stance is to be remaining invested in the funds that we recommended. We've spoke with more fund managers than whatever really. Yesterday I had a good chat with Justin from Legal and General Fund Managers, and I just want to go through some of the things, the key notes and the key points that he said next. Good afternoon. Yeah, so yesterday afternoon I spoke with Justin from Legal and General Investment Management. Justin manages billions of pounds of clients' money. Overall, within Wealth of Advice, we've got around about 35 to 40 million pounds of our clients' money under Justin's control. So he was definitely a good person to speak to get an update on how things are going. Justin explained that the current event, if you like that, or the current crisis that we're going through is what's going to be called an event-driven recession. Most other recessions in history have been caused through an economic downturn where businesses start to fail, people start losing their jobs, inflation starts to rise, excuse me, and those recessions, as I say, people watching this will remember the end of the 1980s. There was quite a deep one, obviously 2007 to 2009. Throughout the 1970s, there was lots of these types of recessions. What we're experiencing right now, as I say, is something borne out by an event that nobody controlled and nobody expected to happen. Event-driven recessions like this are usually short-lived, but they can be very deep. The falls that we've seen in the last few weeks have been quicker and more severe than what you've seen in previous recessions. But, and this was the reassuring thing I took from the call with Justin yesterday, these types of recessions, although they are quick to happen, they're also quick to come out the other side. Clients are asking me, will my pension fund, will my investments ever get to the back value of where they were before the crash? And the experts, Justin, all the other fund managers we're speaking to are saying that yes, they will, and it could be quicker than what you expect. Yes, there's negative news stories about how long this thing may go on for, how long it'll take to get a vaccine, how long, as I say, world governments will respond to it. But right now we're seeing, as I say, economic activity reduce quite a bit. The slide we were showing you now shows that property sales, if you just look at the middle or one at the bottom, are down 43% on the same week last year. Clearly people aren't going out buying houses while we've got this sort of work from home, sort of don't go out, social distancing going on. That will have an impact, but again, once we're through the worst of it, that will pick back up quickly. Coal consumption is listed there. You might think, well, who uses coal right now? But it's still a big use for power stations and for lots of emerging markets. That's down 20%. So you can see that output is going to fall. When those numbers are reflected through, this year will look like a poor year, and the stock markets have already priced that in. That's why the markets fell so quickly and as deep as they did, because they knew this was coming. The reassuring thing which Justin had to say yesterday is that once the markets respond to the emergency stimulus that's gone in, so the reduced interest rates, the extra £750 billion the European Central Bank put into the markets, our government talking about 330 billion, the Americans are putting billions in, if not, I think it's £1 trillion Trump's asking for from Congress. Once that goes into the markets, which is happening right now, the markets at some point will respond to that. Central banks have unlimited resources to do this. It was interesting that Angela Merkel referred to this as being the biggest event since the end of the Second World War, and world leaders are using war as an example, because when a war is going on, all of the financial restraints that a government might normally have imposed on themselves go out of the window. So unlimited borrowing, reduced interest rates. This money is now going to start filtering through the financial system and will end up back in the stock market. Justin said he believes the stock market is almost at a point where it can't go any lower because it's fell so quickly that the value of the underlying stocks represent a lower value in some cases as to what the company is actually worth. If you just think about BP and the other oil company Shell, their share prices fell massively in the last fortnight. The pound has also fallen against the dollar, so those companies are very, very cheap, and there will be big, huge investors out there who will be able to acquire them because they've got so much cash. So as I said earlier, it's not an economic recession, it's an event-driven recession, and once we get sort of some positive news, maybe the infection rate comes down to a certain level, which I'll come on to next, then the markets will turn. Legal in general are hoping that could be within the next 4 to 6 weeks. Some other people are saying it could be a bit longer, but we would like to get maybe towards the end of the summer and hopefully see light at the tunnel, and economic activity looks like it's going to improve, and then the markets will come back up. So yesterday afternoon, so the data which markets are looking for to see to hopefully trigger some kind of recovery, or at least stop the falls in stock markets happening, is to see what the reproductive rate of this virus is. As you can see from this slide, Spain is showing an R of 5.6, and R means the infection rate. So for every person who has the illness in Spain, another 5.6 people will become infected as a result. The UK is sitting at 4.7 there, and our R is rising. If you look at the very bottom, you can see China at 0.1. China is now returning to work. China is returning from lockdown. The Chinese stock market is starting to rise. The T. Rowe Price Global Growth Fund sent us a bulletin on Tuesday saying there's various stocks that they invest in China which are starting to see good growth again, because China's infection rate has been curbed, and that's being done through lockdown. So when you hear these measures on the news that we're going to have social distancing, or we're going to have lockdown, this is why. It's to get the reproduction rate of the virus right the way down. Italy is at 4. They've gone into these draconian lockdown measures a couple of weeks ago. So even the UK go into these measures is not going to necessarily be a negative thing. It hopefully will mean that the virus slows in what it's doing. Once that happens, then we get on top of it. Then we come out the other side, and markets will hopefully pick back up. People talk about do we need a vaccine? Do we need a cure? Well, that's being sort of worked on. The government, as I say, has got a lot of options up its sleeve. But as I say, until that 4.7 figure that you can see there goes down to anything less than 1, then the uncertainty is going to remain in the market. So that, as I say, could take a few weeks yet. But as I say, China was well above 5 only a month ago, and it's now down to 0.1. We just need to do the same. You will remember from previous updates that we've given, we do look at sort of where investments are in respect of the current economic cycle, our valuations, overpriced or underpriced. The view that we've been getting from a lot of people now is this is likely to be a temporary but deep recession. Inflation is going to be really, really low in the long run. As I say, interest rates coming down helps that. We've had a very quick response, and as I say, valuations right now, the valuations of your investments, as you can see from looking at that, are really, really low. That means companies become attractive to invest into. The percentage dividend that they issue compared to the share price looks attractive for those companies looking to invest for income. So overall, whilst caution is being sort of advised, and all of the fund managers that we're dealing with are trying to make their portfolios more cautious than they were prior to this, you will see that optimism comes back into markets in a few months' time, and that caution can be removed and the markets will rise. Right now, as you can see, the systematic risk, it's the uncertainty of the impact of this virus. That's the main thing we need to get over. And as I say, hopefully that is a few weeks away. This slide here shows the current breakdown of a particular multi-index fund that we use. I think all of our clients are invested in one form or another in some form of multi-index fund or multi-asset fund where you're investing across a wide range of asset classes. As you can see from there, Royal London right now have either gone overweight or underweight in certain areas. US Treasuries at the top have gone overweight. Why are US Treasuries overweight? Well, that's because the US government is always regarded as the safest place to bank your money at times like this. This is why the dollar rises and the pound against the dollar, and all of the currencies against the dollar won't do as well. But as you can see, under there you've got UK index-linked gilts, UK other bonds, you've got German bonds, Austrian bonds. So a lot of money will fly into these areas. You've got corporate bonds, which are loans issued by companies, and then down the bottom, stock market-based investments. Fund managers are underweight in those areas at the moment. The underweight will look because partly because the fund values and the share prices have fallen so much, but once say the market turns, they will seek opportunities and look to sort of rise out of that. And as you can see there, this particular fund manager favours the US dollar and the pound over the euro, and that's how they're going to structure their positions to try and get out when the market bounces back. As I say, Boris Johnson and all world leaders are doing as much as they possibly can to get us out of this. You might not agree with things that Boris says, but please be reassured that it's not him making these decisions necessarily. It's experts and economic advisors behind him, the governor of the Bank of England, the guy who runs the Fed, the leader of the European Central Bank. They will be talking continuously to come up with ways and strategies to get out of it. So whilst we can't stand here now and say we're going to be positive of anything that's going to happen over the coming weeks, because it is all bad news that you're seeing in the news, the one thing that we would say is that we expect that once this turns, the markets will recover quickly and asset values will come back. It's not going to be something where you see your funds stay low for sort of 3-5 years, as a couple of people have asked. It's an event-driven recession, and history shows that these tend to sort of be the ones that are recovered from quickly. We are making changes where appropriate to certain portfolios. The vast majority we're leaving exactly the same. As you can see from this slide, fund managers are making those changes themselves, either going underweight or overweight in certain areas. And as I say, we just have to keep our trust and confidence in them. And as I said earlier on the presentation, if anyone wants to get in touch, please ring the office, please email me, and keep in touch. And we're going to keep sending out these regular bulletins at least once a week as this thing goes on. Thank you.